A financial storm is brewing as investors hastily exit American assets, as if fleeing an impending tempest. This is due to the escalating trade tensions triggered by President Donald Trump's administration policies. What exactly happened, and why is it so important? The euro has reached a 3-year high against the US dollar, indicating growing concerns about America's economic stability. In early April 2025, the euro's exchange rate experienced a dizzying surge, soaring from 1.0807 on April 1 to 1.1351 by April 11, equivalent to a gain of over 5% in just 10 days. This sharp rise reflects increased demand for the European currency as investors rush to withdraw their funds from American assets amid heightened trade tensions and political instability. The catalyst for this currency movement was President Donald Trump's announcement of sweeping tariff measures. On April 2, 2025, the Trump administration imposed a baseline 10% tariff on all imports into the United States, with higher rates set for specific countries. The United States' implementation of protectionist measures, such as a 145% tariff on Chinese imports and 20% on European imports, aimed at safeguarding American industry and balancing trade deficits, has had unpredictable consequences for the global economy. These actions triggered sharp fluctuations in global markets, forcing investors to seek refuge in more stable assets, with the euro emerging as a favorite. The unexpected introduction of tariffs, compounded by contradictory statements from the administration, such as the promise of a 90-day deferral of reciprocal duties for most countries except China, only exacerbated the market confusion. Such unpredictability undermined confidence in U.S. economic policy, triggering capital flight and weakening the dollar's position. Against this backdrop, the euro, supported by the European Central Bank's consistent policies aimed at maintaining stability, became particularly attractive to investors. The U.S. dollar index, DXY, which reflects the value of the American currency against a basket of major world currencies, declined noticeably, falling below 100 points for the first time since July 2023. By April 11, 2025, the U.S. dollar index, DXY, had fallen to 99.78, demonstrating a 1.07% decrease compared to the previous value of 100.87. This dynamic reflects deepening concerns about the resilience of the American economy, driven by escalating trade conflicts and unpredictable political conditions. President Donald Trump's decisive actions, expressed through the introduction of sweeping tariffs, including a 10% tax on all imports and increased rates reaching 145% for Chinese goods, triggered significant fluctuations in global markets. These protectionist measures forced investors to reassess their risk assessments associated with American assets, leading to capital flight and a weakening of the dollar's position. In the face of growing uncertainty regarding the economic policies of the United States, investors turned to traditional, safe haven currencies. The Swiss franc and Japanese yen strengthened against the dollar, indicating a notable shift in market sentiment. For example, the Swiss franc reached a peak of 175.234 against the Japanese yen on April 11, 2025, reflecting increased demand for stable currencies during periods of market instability. Financial experts are sounding the alarm. The weakening of the dollar's position could trigger a chain reaction with unpredictable consequences for the American economy. The fall in the value of the American currency calls into question its role as the world's primary reserve currency, which threatens to reduce global demand for assets from the United States and increase the cost of borrowing. The United States budget deficit, which reached $1.8 trillion in 2024, could become even more painful if demand for dollar-denominated securities continues to decline. Notably, the devaluation of the dollar coincided with a dizzying surge in gold prices, which reached a historic peak of $3,223.72 per ounce on April 11, 2025. This trend indicates growing investor concerns as they seek reliable ways to preserve their capital in the face of increasing economic turbulence. President Donald Trump's aggressive tariff policy has already caused serious fluctuations in U.S. financial markets, triggering a massive sell-off of both Treasury bonds and stocks. This market instability further undermines confidence in the American currency and raises serious concerns about the future prospects of the economy. U.S. Treasury bonds, historically considered a safe haven in turbulent times, have faced unprecedented turbulence. Following the announcement of sweeping tariffs on April 2, 2025, investors, akin to a startled flock of birds, rushed to unwind complex financial structures such as basis trades and swap spread strategies, triggering a genuine liquidity crisis. This mass exodus from Treasury bonds caused a sharp spike in yields. The 10-year Treasury yield soared from 4.2% to 4.4343% in just 4 days, marking the fastest increase since the 2008 financial crisis. A similar pattern was observed with 30-year bonds, the yields of which experienced the most rapid 3-day increase since 1982. Market panic was fueled by fears that major foreign holders of U.S. debt, primarily China and Japan, might begin to reduce their substantial holdings, inevitably leading to further market destabilization. Concurrently, U.S. stock markets began to suffer significant losses. Key indices, including the S&P 500 and Nasdaq, entered correction territory, with the S&P 500 plummeting more than 10% in just 2 days, a worrying signal for the global economy. Financial markets are experiencing a period of turbulence comparable only to the chaos caused by the COVID-19 pandemic in 2020. The Dow Jones Industrial Average, a barometer of the American economy, is exhibiting an unprecedented fall, losing more than 1,500 points, its sharpest decline in history. Investors, gripped by panic and uncertainty, are witnessing a staggering $6.6 trillion evaporate from the market. Consumers are also feeling the effects of this economic instability. According to data from the Yale Budget Lab, the average American family will face an additional $3,800 per year in expenses due to rising prices on imported goods. This surge in consumer prices is expected to lead to a 2.3% increase in inflation in 2025, further intensifying the pressure on the economy. In light of these negative trends, economic growth forecasts have been revised downward. The U.S. Federal Reserve lowered its GDP growth forecast for 2025 from 2.1% to 1.7%, while the OECD expects growth to slow to 2.2% in 2025 and 1.6% in 2026. Amid growing tensions with the United States under the administration of President Donald Trump, the European Union and Canada are strengthening their trade ties, seeking to diversify economic partnerships and reduce dependence on the American market in 2025. Amid the growing turbulence in the global economy caused by the protectionist measures of the United States, the European Union and Canada have intensified the search for reliable and promising economic alliances. In this regard, the strengthening of ties between Brussels and Ottawa appears to be a natural and promising step. In February 2025, Canadian Prime Minister Justin Trudeau held a series of high-level meetings with key figures in European politics, European Commission President Ursula von der Leyen, and European Council President Antonio Costa. The leitmotif of the negotiations was the discussion of ways to expand economic cooperation between Canada and the EU. The leaders agreed that deepening cooperation is a necessary condition for ensuring global economic security and stability, especially in the context of increasing geo-economic tensions. The basis for optimism is the impressive dynamics of bilateral trade recorded since the start of the provisional application of the Comprehensive Economic and Trade Agreement, CETA, in 2017. In the period from 2016 to 2022, the volume of trade in goods and services between the EU and Canada increased by 65%, which indicates significant mutual interest. At the same time, exports from the European Union to Canada increased by 60%. The most notable progress was observed in the supply of pharmaceutical products, growth of 74%, agricultural products, growth of 50%, and machinery products, growth of 42%. These figures clearly demonstrate the potential for further development of trade and economic relations between the EU and Canada. In 2022, the European Union demonstrated its economic power by sending goods to Canada totaling approximately $49.11 billion. This impressive list was led by sophisticated machinery, vital pharmaceuticals, modern vehicles, and much-needed mineral fuels. Canada, in turn, became increasingly convinced of the strategic importance of the European market. The European Union has firmly established itself as Canada's second-largest trading partner. In 2024, Canadian exports to the EU reached $34 billion, while imports from the EU reached an impressive $84 billion. These figures represent a significant increase compared to 2015. Exports increased by 57% and imports by 61%. However, not everything in global trade was going smoothly. The Trump administration's decision to impose a 25% tariff on all Canadian imports, with the exception of energy products which were taxed at 10%, presented a serious test for U.S.-Canadian relations. In response, Canada retaliated by imposing tariffs on $29.8 billion worth of U.S. goods, targeting key industries such as steel, aluminum, and automobiles. These events strongly encouraged Canada to seek alternative markets and strengthen existing partnerships, particularly with the European Union. It is worth noting that the European Union itself has faced challenges in its trade policy with the United States. The rejection of a proposed zero-tariff agreement aimed at eliminating industrial tariffs between the two sides has created further challenges for the European economy. The European Union and Canada are actively exploring opportunities to deepen trade and economic ties. Expanding cooperation in the defense sector is also a key focus. Ottawa is examining the possibility of purchasing military equipment from European manufacturers, seeking to diversify its supply sources and reduce its dependence on American companies. Both sides demonstrate a unity of views regarding global trade based on clear and understandable rules, and are making joint efforts to maintain multilateral trade agreements. This consolidated position reflects the desire of the EU and Canada to resist protectionist tendencies and strengthen economic stability in the world. The strengthening of the euro indicates a revision of investment strategies. Amid trade tensions triggered by U.S. policies, investors are increasingly viewing European assets as a more reliable and secure alternative. If Washington continues to pursue policies that undermine confidence in the U.S. currency, this could lead to a long-term rebalancing in global currency markets. The dollar has already fallen by more than 1% against a basket of major currencies, reaching its lowest levels in the last 3 years. And since the beginning of the year, the U.S. currency has lost almost 10% of its value. Even after some tariff adjustments, including temporarily excluding China from a 90-day freeze, investors continue to worry about the unpredictable policies of the United States. This undermines the established reputation of the dollar as a reliable safe haven asset. The Trump administration's tariff policy has not only led to a deterioration of international relations, but has also caused tangible economic consequences within the country, including slower GDP growth and rising consumer prices, especially in Europe. While the short-term consequences for export operations are clear, diversifying trade strategies can help mitigate risks in the long term. According to estimates by the Yale University Budget Laboratory, the average effective tariff in the U.S. has reached 22%, significantly higher than the 11% that existed before the new measures were introduced, and is the highest level since 1909. Analysts from Inflation Insight predict that the average weighted tariff rate could rise to 25 to 30% compared to 2% in the previous year. To gain a more complete understanding of the current state of the world economy, it is advisable to consider the historical role of the U.S. dollar and its influence on shaping the global economic landscape. For decades, the U.S. dollar has been the cornerstone of the global monetary system, participating in more than 85% of all international currency transactions and accounting for about 60% of currency reserves worldwide. However, this dominant position has recently come under pressure from several factors. These include growing geopolitical tensions in various regions of the world, increasingly unpredictable U.S. domestic policies, and a growing desire among many countries to diversify their economic risks. This rejection of the dollar, widely known as de-dollarization, has been developing gradually, but recent events have given it additional relevance. Disruptions in global trade, chaotic U.S. tariff decisions, and increasing exchange rate volatility have prompted many countries and large corporations to reconsider their dependence on the U.S. currency. De-dollarization is essentially a strategic maneuver aimed at reducing dependence on the dollar in trade, reserves, and financial infrastructure. The reasons for this phenomenon are diverse. These include concerns about the United States using its currency as an instrument of sanctions, the ripple effects of U.S. monetary policy on global capital flows, and a broader desire, especially among emerging economies, to assert greater monetary sovereignty during crises. In an era of global change, several key figures have come to the forefront to lead the tectonic shifts in the global economy. China is steadily strengthening the position of the United Nations, especially in the area of energy trade, while Russia is increasingly using the ruble and UN mechanisms for settlements. Associations such as BRICS and the Eurasian Economic Union are also seeking to develop strategies to reduce their dependence on the dollar and create an alternative currency system. At first glance, the weakening of the euro may seem counterproductive to the process of de-dollarization, as it reinforces the relative power of the dollar. However, paradoxically, this factor may actually accelerate the global departure from the dollar and other traditional Western currencies. In a situation where both the dollar and the euro show signs of instability, states have an additional incentive to enter into bilateral trade agreements that bypass both of these currencies. In today's world of financial transactions, agreements concluded in national currencies or using regional stable alternatives are gaining popularity. An example of this is the recent agreement between India and the United Arab Emirates, according to which oil transactions are carried out in rupees. Brazil is also demonstrating a similar trend, trading with China in yuan and using regional investment instruments. The recent instability of the euro only reinforces concerns about the risks associated with dominant currencies and encourages the search for alternative solutions. This situation has also sparked interest in regional currency systems as a potential stabilization tool. Turbulent relations between the dollar and the euro are pushing associations like BRICS to accelerate the development of alternative settlement mechanisms. Various options are being considered, including the creation of common currencies or the use of digital assets, such as the digital yuan or the digital euro. These efforts reflect a general desire to reduce dependence on Western financial instruments. Central banks are also actively responding to the ongoing changes. In an environment where the euro is under pressure and the dollar is criticized for its political instrumentalization, some countries are reviewing the structure of their reserves. There is a tendency to increase the share of gold and other stable assets that are less susceptible to political influence. In 2024, the International Monetary Fund presented data indicating a gradual retreat of the dollar from the pedestal of the world's main reserve currency. The share of the U.S. currency in global reserves decreased by 1.5%, giving way to gold and other currencies. The emerging trend, it seems, will continue to gain momentum, forcing the world's leading economies to revise their strategies. The European Union, recognizing the new challenges, seeks to strengthen trade ties with African countries and Canada, seeing this as a way to diversify economic flows. Behind the scenes, the idea of creating a digital euro is being discussed, which could become a more flexible and sustainable reserve instrument. In addition, the EU is establishing currency swap lines with the central banks of countries outside the Western bloc, seeking to stimulate trade in euros and strengthen confidence in the European currency. The United States, in turn, faces growing discontent in the world due to the use of the dollar as an instrument of political pressure. If the process of de-dollarization continues to spread, it could undermine the U.S. influence on global financial rules. The recent fall in the euro may have temporarily cast doubt on its ability to compete with the dollar. However, this episode only emphasizes the vulnerability of any single reserve currency in today's unstable and multipolar world. The current stage of development of the global economy, contrary to expectations, has not stopped the process of de-dollarization, but, on the contrary, has given it additional impetus. More and more states are coming to the understanding that the future of the global financial system lies not in replacing the dollar with a single alternative currency, but in creating a multipolar space where various instruments, such as gold, digital currencies, and regional trade agreements, will ensure diversification and sustainability of international economic relations. It is likely that the era of the post-war hegemony of the dollar as the sole global reserve currency is gradually receding into the past, giving way to a more complex and balanced system that reflects changes in the balance of power in the world arena. In early 2025, former U.S. President Donald Trump made a high-profile statement addressed to the BRICS countries, Brazil, Russia, India, China, and South Africa. Amid growing signs of these countries' desire to undermine the dominance of the dollar, Trump warned of the U.S. readiness for tough measures. In particular, He mentioned BRICS' plans to create an alternative currency and expand trade in national currencies, stating that the U.S. would impose aggressive tariffs in response to such actions. At a campaign rally, Donald Trump declared his intention to demand guarantees from countries he called hostile, assurances that they would not create a new BRICS currency or support any alternative to the U.S. dollar. Otherwise, he said, these countries would face 100% tariffs. Let them find another sucker country, he added, emphasizing his resolute stance. However, economists and international policy experts note that such harsh rhetoric and trade policies, particularly the large-scale tariffs introduced under the so-called Liberation Day, could backfire. While aiming to protect U.S. economic interests, these measures, according to specialists, undermine confidence in the dollar globally and inadvertently stimulate de-dollarization processes. The currency market's reaction was immediate. Following the announcement of tariffs and increased trade threats, the U.S. dollar index fell by more than 1% in a week, marking the sharpest decline in the last 3 years. Since the beginning of the year, the decline has been almost 10%. A clear trend has emerged in financial flows. Investors are leaving U.S. dollar-denominated assets in search of safer havens. Gold, the Swiss franc, and even cryptocurrencies are increasingly being viewed as safer capital shelters. The once unshakable status of the dollar as a benchmark of stability and reliability is now being questioned, not only by other countries' governments but also by large institutional investors and even central banks. In the context of global trade, concerns about the reliability of the United States as a partner are increasingly voiced. In response to Washington's actions, China has introduced retaliatory tariffs, reaching 125%, on imports of American goods. Countries like India and Brazil are increasingly using local currencies or Chinese yuan in settlements for key transactions in the energy and raw materials sectors. Undermining confidence in the American currency encourages the conclusion of currency swap agreements and the creation of regional payment systems, further reducing the dollar's role in international transactions. International financial institutions are also not standing aside from these changes. The IMF and the World Bank note a slight, but noticeable redistribution in the structure of global reserves. In 2025, according to an IMF report, the global financial system continued its trend towards diversification, which was reflected in a decrease of 1.8 percentage points in the U.S. dollar's share of global reserves. Gold, the Chinese yuan, and other alternative assets, on the other hand, showed moderate growth in the reserves of central banks in various countries. Financial regulators in Asia and Africa have been particularly active in revising their portfolio structures. This diversification process has become a response to the politicization of the dollar, which, according to many experts, intensified during the Trump administration. The economic policy of that era, particularly the tariff wars, may have contributed to the weakening of the U.S. position in the global economy. The increase in import costs caused by tariffs fueled inflation, and retaliatory measures by other countries led to a decrease in demand for American exports, especially in the manufacturing and agricultural sectors. Such pressure may have forced the Federal Reserve to take a softer stance on monetary policy, which, in turn, would have led to a further weakening of the dollar due to widening interest rate differentials compared to other major economies. At the same time, the fiscal position of the United States continued to deteriorate amid growing national debt and budget deficits. This certainly undermines confidence in America's long-term financial stability. Critics argue that the Trump administration pursued a risky economic policy, instrumentalizing trade relations and politicizing the dollar, without paying due attention to the long-term consequences of such actions. It is argued that Trump's actions, aimed at protecting the dollar, paradoxically pushed the world towards a multi-currency system, a scenario he seeks to avoid. His supporters, however, see this as an inevitable recalibration needed to establish fairer trade relations and reorganize global supply chains. Short-term fluctuations, in their view, are the price worth paying for restoring America's economic sovereignty. Nevertheless, even in the financial circles of the United States, there is growing concern that alienating major economic partners could lead to an irreversible abandonment of the dollar in international settlements. Trump's warnings to BRICS and tough tariff measures reflect a desire to maintain the dominant role of the American currency in the global financial system. However, the effect of these actions appears to be the opposite. By increasing distrust, creating economic uncertainty, and stimulating the formation of disparate global alliances, the policies pursued are only accelerating the process of de-dollarization of the world economy. What previously seemed like a barely noticeable movement of tectonic plates is now turning into a powerful geopolitical shift. And it's not just about America's traditional rivals, but also those who until recently saw the dollar as a bastion of stability, trading partners and international institutions. If this trend continues, the world may witness a historic turning point in the currency system. Paradoxically, the acceleration of the process of the dollar losing its position as the world's reserve currency is not happening under pressure from external forces, but at the initiative of the very country that is most interested in protecting it. Here, the author invites readers to share their opinions on the relationship between the EU and the US in the comments. That concludes this episode. The author expresses sincere gratitude to the viewers for their time and attention. If the presented material was useful or inspiring, he encourages you to support the channel with a like and subscription to stay up to date with new publications and contribute to the development of the community. The support of each viewer is of great importance. In conclusion, you are invited to familiarize yourself with other video materials on the channel. The gaze is fixed on the screen, where a kaleidoscope of events unfolds, broadcast by the TV channel. The flow of information captures attention, transporting the viewer to the epicenter of news, discussions, and entertainment programs that shape the picture of